Okay, good morning, everybody. We're going to get started for today. So we are Wednesday of week 10. I think I mentioned on Monday we're week 9, but we are week 10. And so let's kind of take a look here at where we are and the activities that we're covering. And I want to sort of start, as I often do, with the syllabus and just to kind of see where things are. So let me just go scroll down here so you can see where we are. So week 10 here. And we're pretty much right on track with the syllabus. I mean, we really very rarely deviate from the schedule that we're supposed to be on. So we're going to cover incremental analysis, and we started this on Monday. I think we're going to more or less finish the content. If we don't, that's perfectly fine because next week is your exam. Second exam covers 3 chapters. Chapter 13, the appendix F, which is really not a chapter, but it really is kind of a half chapter, and then chapter 14. And we're going to talk more about that next week. So what I plan to do with regard to the exam is to talk on Wednesday of next week about what some of the tips and tricks are on the exam itself. I'll do a view session for that so you can be familiar with what's going on the exam. So today what I'm going to do is I'm going to cover the rest of incremental analysis. And I moved the due date, even though the syllabus says November 3rd, I moved it to November 10th. Which is also the due date of the exam itself. So I realize that I'm sort of maybe backloading some of the work to be done here. But if you want to work ahead, feel free to work ahead. That's perfectly fine, and it's acceptable. And I know a lot of people do that, and so it makes sense to sometimes engage in that activity. Okay, so I want to pick up from where we left off last time. So does anyone have any questions before we begin here with regard to anything we've talked about up to this point? We have pretty small attendance in the Zoom room and also in the physical room, so that's fine. That's not a problem. A lot of people are watching it on the recorded link, and that's perfectly fine. I do want to remind everybody to post their attendance to the attendance links that I post under the discussions tab under coursework discussions in Brightspace. It's not for my benefit, it's for the government's benefit. So please do that if you would. I realize that sometimes we've had very little participation in that area. And so sometimes it's hard to know what day you reviewed the text or the course material, but nonetheless, it is required that we record attendance somehow. Okay. So here's what we're going to do. We're going to talk about the rest of chapter 14 today, dealing with this idea of incremental analysis, and we're going to finish. I think mostly finish that discussion, and then we come back on Monday. What I'll do is I plan to really spend the majority of time on Monday going through some end of chapter problems and exercises that should sort of illuminate and flesh out some of the issues that problems that arise in incremental analysis. Now, let me just kind of zoom back out here a minute. Incremental analysis is this idea of saying, okay, we're faced with a decision, and management has to make a decision as to what to do. Do we do this one thing or do we do this other thing? And I realize that sometimes it's not just one or the other. I know we maybe simplify this oversimplify it by saying it's A or it's B, but it may be A, B, C, D, or E. Then we have to choose among. And so the idea is, what do we do given these options? And this is, as I mentioned on Monday, this is, I think, really where accountants shine and earn their pay, is to determine what the most profitable objective is given the scenario that's given at hand. So that's what really is going on here. And so one of the things that we sort of talk about with regard to chapter 14 is the idea that once we sort of define what the whole idea of incremental analysis is, incremental is simply the additional revenue, the additional cost that might be involved in some decision that we made. That's all it is. Incremental is sort of, in economist parlance, we call it marginal revenue versus marginal cost, or incremental revenue versus incremental cost. And that is, if we do something, what's it going to result in an effect on the bottom line? And remember, we're focusing here really on relevant costs. Also relevant revenues, but relevant costs are really sort of the main event here in terms of this. And so we're going to cover the first of these. And I know we talked about this a bit on Monday. I'm going back a little bit here in order to go forward. That's the idea. Talking about one of the very classic cases of decision making: make or buy, lease buy, buy or build, complete or continue production. All these are examples that we're going to cover in this particular section. So on Monday we talked about this idea of make or buy, and we had an example of a company made ignition switches for motorcycles. And again, I talked about this on Monday. I don't want to spend lots of time on it, but I do think it's it's worth looking at. And that is the idea that, look, this company incurs these costs, direct materials, direct labor, and we've divided up overhead into variable and fixed manufacturing overhead. And this is really, I think, the first in this section we've done this, where we've taken overhead as one of the product cost categories: materials, labor, and overhead, and we divided it into fixed and variable. Now, the fixed and variable discussion really began in chapter 13 under CVP, where we really weren't terribly interested in what was the product cost and what was the period cost. We were more interested in what was variable and what was fixed. So we're kind of used to this idea of what these definitions are, except that now we're sort of dividing these in two here, because they're going to be impacted differently, probably, by some decisions. So in this case, we have the total cost, and we have total manufacturing costs based upon this particular scenario of making, let's look at the quantity, 25,000 of 225 divided by 25,000 is $9 per unit. And the question is, if we have a special order where somebody says, we're going to offer you $8 per unit, do we take it or do we not? At first glance, and again, your text is, I think, very appropriately centered on the idea of the counterintuitive nature of this analysis. Because at first glance, we would say, heck no, it cost us $9 to make the good. Why would we sell it to you for $8? The problem is, some of these costs are already incurred, and they're not going to change regardless of what we do. So as a result, we have to understand what relevant costs are and what they're not. And I know I'm going back a little bit here in order to sort of going forward, but I think the issue really deserves some attention, and that is the idea that I think I lost my. What did I do? I think I lost one. Pardon?
You're on the slide 20.
Yeah, 20. Yeah, I think it was. I lost my thread here. Yeah, here we go. So the idea is here. First of all, we disregard the fixed cost. So, and as a result, we have these are the total costs we had from the previous slide. We know the purchase price. If we buy these, as opposed to make them, it's going to be 25,000 units times 8, or sell these, I should say, times $8. It's going to make this figure here. The purchase price is going to be 200,000. So, as a result, what have we got going on here? Is this the right slide? Yeah, I think it is. So this, because the question is, do we buy or do we make? And so as a result, we're saying that it's going to cost us more to buy them as opposed to making them. So this particular example, it makes more sense to make the goods than to buy them. So because making them is the current scenario where we got all these costs that are included here. And so we're going to save 10,000 in manufacturing costs of a fixed nature. We're still going to incur it. We're going to save, and these are the purchase price of the new units. So if it makes sense to do that, then we should do that. And one of the things that we should mention, and I know I talked about this earlier in certain sections, is this idea of an economic term called, it's actually a Latin term called ceteris paribus. And ceteris paribus, if you've not taken economics before, is really a Latin term that means all else remaining equal. Ceteris paribus. And I am not one that's big on Latin terms. I'm not a lawyer, so I don't really engage in that. But the idea is that if everything else is equal, this is what we ought to do. That is, what do we mean by all else remaining equal? That is, are there issues that we are not familiar with that we should take advantage of, that we should account for in our discussion? And one thing that comes to mind is the idea, and I think I sort of mentioned this on Monday, is the idea sometimes companies don't want to take a lower price for what they're doing, even if it results in an increase in net income. And by the way, these are red. Sometimes we think of red as being negative, red ink, and that sort of thing. But we're sort of conditioned to think of the idea that companies should do whatever makes sense to make increased income. But the problem is with this, and I mentioned this on Monday, is that oftentimes bank lenders will sort of restrict what borrowing companies can do because they have to maintain certain ratios, certain financial ratios like ROE, gross margin, all that. So it may not be possible to do that. Also, one other thing that I mentioned last time, did not mention last time, was that I think is really important is the idea that sometimes companies have their own internal policies as to what they want to achieve in terms of these accounting metrics. And one example that I can think of that goes back to my days back as a commercial lender was we had a company that made lots of plastic things, license plates that would go on the front plate with sports teams and all that. They would make dividers that would, in the meat department, that would just plastic junk, really. I mean, but it was profitable junk, and so it would amaze you how much stuff companies make off producing things we take for granted, all the physical stuff around us. And so this company was faced with the opportunity of doing a special order, and it was the idea of, do we do it or do we not do it? The policy the company had was no one buyer could exceed, I think it was 14% of sales. And why do you think that would be? Why would a company be concerned with having one buyer exceeding their own sort of speed limit as to sales? And the reason really is because first of all, you've really got to understand that as easy as it is to turn on the contract, it's easy to turn it off as well. And if you've hired additional people, bought more equipment, expanded facilities, it's a problem. So this company is faced with a particular contract where they were asked whether or not they want to produce plastic lids for coffee cups of a pretty major fast food company on the East Coast. And they decided to do it, even though it was going to push them over that limit of one company and sales confined to that one company. But they did it, and they agonized over it, and they talked to us about it. And we said, well, I wouldn't invest a lot in equipment or facilities to do it. And they did it, and it made sense, and it paid off. But you get the idea that sometimes internal policies are speed limits on this issue. So I want to make clear here, I'm sort of adding a little bit of nuance to this because I think it's important. If we're only looking at this, ceteris paribus, which is a term meaning if all else remains equal, yes, it makes sense that we should do what? We should continue to make the unit as opposed to buy, right? Because it's cheaper to do that, so that makes sense in this particular scenario. However, there are additional elements out there that are to be considered. So one of these is opportunity cost. Now, opportunity cost, we've talked a bit about that on Monday. And what is opportunity cost? So this is an element, this is a idea that really comes from the accounting profession. It's the idea that we account for the lost benefit that might have been achieved had we not done one thing or the other. Opportunity costs are all around us. They're all around us. If we do one thing, it means we foreclose the opportunity to do another thing. So if I choose to work as opposed to going to college, maybe I earn more in the next 4 years than what I would have in college. But that's the opportunity cost, is the fact that a college degree lends itself to more lifetime earnings. And so as a result, that's a small price to pay, but it's a price to pay nonetheless in the very short run. So the idea is the lost potential benefit that could be obtained from doing one thing as opposed to the other. And in economics, I know a lot of our students have not yet taken microeconomics, and this is a topic that comes up again and again in micro. We sometimes call it implicit cost. It's the idea of something that we did not get the benefit of because we chose one thing over another. And because of that, that's really an important consideration when it comes to determining what's the most profitable outcome. And here, I want to reiterate something I think I mentioned on Monday, is the idea opportunity cost is a sort of an economic concept. It's really not a financial accounting concept at all. Rarely do you see in financial accounting statements, that is GAAP prepared statements, any mention at all of opportunity cost. If there is a mention, it's somewhere in the notes that says, well, we had a tire production plant in Stuttgart, Germany that burned down, no longer exists, and it produced 200,000 of contribution margin. That plant is no longer gone, so it doesn't hit the income statement because there's no event to hit the income statement other than the fact that the lost opportunity to create whatever it was that was going on. Okay, so opportunity cost, it's a nebulous concept. It's really it's something that does not limit itself to our own particular day-to-day living, but I think it's very important as well. Okay. All right. So we talk about opportunity cost example. Here's an example. So the parent company uses can release the productive capacity to generate additional 38,000 from producing a different product. So we go back to this example here where this is a company that makes ignition switches at a price of $8 per unit. Okay, and we decided that it doesn't make sense to farm this out. And by the way, this is going to be a recurring theme throughout this module where the company has to decide, do we produce it or do we buy it? It's a make or build kind of scenario. And the two really are not compatible. They're binary decisions. However, there are cases in which, as we'll see a bit later here, where companies can sort of split the difference, produce it part of the way, and maybe not part of the way. But this is the initial scenario that's given, is the idea that we have one thing versus another. And so if we factor into this the idea that if we decided to buy the switches, we could free up manufacturing capacity to produce an additional income of 38,000 from doing something else. And so this changes the equation. So now the opportunity cost of not buying is an element of the decision to make the product. And so as a result, now we should probably make the product if that's what is going on here. So all these costs are costs and revenue streams are very intricate and have to be accounted for. And this is where accountants have to be very careful at trying to account for all the relevant variables. And sometimes things get missed. But this is an important one here. It's the idea that if we do one thing, maybe it doesn't make sense to do the other because we can't do both, right? But in this case, what if we decide to not to buy it and to make it? Well, then we can free up resources that will allow us to produce X dollars of income, 38,000 of extra revenue. So therefore, the decision changes. Okay. So these are what we call relevant issues, relevant revenues, relevant costs. And we have to take account of that. And if we don't, we're going to sort of make bad decisions. And in economic parlance, we call these marginal decisions. If the marginal benefit exceeds the marginal cost, we should do more of that. If the marginal cost exceeds the marginal benefit, we should dial it down. It's a pretty simple characteristic, assuming that everything else is the same. And this is maybe sometimes a taken for granted assumption because not always is the case that things are going to be the same. But given the scenario we're given, this is the opportunity and the direction we should go. Okay. So make or buy decision. In a make or buy, relevant costs are what? Manufacturing costs will be saved, purchase price of units, opportunity costs. It's really all of the above, isn't it? It's really all of the above in this particular example. Okay. Okay. So any questions before we get going into some examples here? At this point, I've sort of walked you through some of the preliminaries. I haven't done a lot of the layout of the math as to how this is involved. And again, the math is not your enemy here. It's really sort of a way to work out some of these problems. But I do want to kind of get into some of the examples here to kind of better illustrate, I think, what the layout is of incremental costs, incremental revenues, which allow us to make a decision. So let's go to this example here. So this is Juanita Company must decide, this is your text, whether to make or buy some of its components for the appliances it produces. The costs of producing 166,000 electrical cords for its appliances are as follows. And you have all these direct costs, direct materials, 90,000, direct labor, 20,000. And these are also direct costs, variable and fixed overhead, 32,000 for variable, 24,000 for fixed. all we're doing here is we're separating out variable and fixed overhead. And let's talk a bit about this because we mentioned this, I think, a bit on Monday, is the idea that up to this point, we talked about overhead as being sort of a grab bag, sort of a junk drawer, whatever you want to call it, of all the costs, which are difficult to categorize. They're part of the product cost. They are part of the product cost, but they're difficult to sort of assign individual units. So we got to kind of do things with them that make them different. And we talked about this in activity-based costing. What do we do when we're talking about incurring overhead and applying it to individual costs, unit costs of output? Here, we're sort of dividing between variable and fixed. And for those of you who are accounting majors and will want to study cost accounting, you will get much, much, much more of that. So in this case, these are the facts. So these are sort of givens. These are the costs. So the scenario is, instead of making these boards at an average cost of $1, that is $166,000 divided by 160, it's hard to say, 166,000 units, they have an opportunity to buy the boards at 90 cents per unit. So it costs us $1 to make. We can buy them for 90 cents and then we sell them at whatever price. A price which is not like given, but it's not really relevant. So the issue is, do we make these goods with these cost figures, or do we buy the goods at 90 cents per unit? Now, at first glance, it looks like, okay, the decision is easy. It costs us less per unit to make, less per unit to buy them than it does to make them. But do we want to do it or not? And the answer is going to be maybe surprising. So all we're doing is transferring all the data from the previous slide to the make column, because that's the current condition. We incur these materials, labor, overhead, 166,000. But if we buy them, we are going to do what? We're still going to incur fixed manufacturing costs. Now, by the way, why is this not an irrelevant cost? And the reason why is because it's part of overhead. Remember, we talked about fixed costs as being not relevant costs, and therefore should be disregarded because they can constitute things like salaries of managers and insurance on the building and depreciation, things which are not really going to go away, property taxes, all that. But these are product costs. These aren't period costs. These are product costs. And we're going to save 25% of those. So we're still going to incur that. And we're going to incur 149,400, which is 90 cents times the 166,000 units. So as a result, we're actually going to be worse off if we buy the units. So the answer is here, and I know the dollar figures aren't particularly compelling. $1,400 of savings is not all that impressive, but nonetheless, the idea is that we should continue to make the product as opposed to buy it, because the incremental analysis does not indicate that we should do it, okay? Under this scenario, this is just one scenario. Now, what if the scenario changes? And the scenario now says, okay, well, would your answer be different if, because now we're buying the good and we're releasing the productive capacity to do things, that we can now produce more income as a result of this? And so, and I think it drops all the way down to income. And we don't know what the product is or it doesn't matter. It just means that now it's an opportunity cost. It's an opportunity cost to the make side. This is what throws people off a lot of times, is the idea that opportunity cost does not apply to the decision being made. It's applied to the decision being foregone. So if we just choose now to buy as opposed to make, this becomes an opportunity cost here. And so now the total cost exceeds that which results in a buying decision. So maybe now we should buy, because the effect on net income is going to be greater than what the effect on cost is going to be. And I know the dollar figures here are probably a pretty small ball for a lot of manufacturing operations, but nonetheless, it really sort of lays out the case that things are different, things change. This is a very complicated area of business. It really is. And it requires lots of judgment on the parts of managers to sort of decide what's relevant, what's not relevant, what do we do in this case. And this idea of opportunity cost is one that I think probably is not well understood, in the idea that we need to accept it as being something that's real And again, I reiterate something I said on Monday with regard to opportunity costs. This is not a cost that shows up on the income statements. This is not part of GAAP accounting. So in principles one, we talked a lot about the idea of GAAP accounting and what goes into it. We said the costs have to be measurable, verifiable, reliable, and that's not what's going on with opportunity costs. But opportunity cost, nonetheless, is a real cost in the sense that we're giving up the opportunity to earn some additional value of doing one thing as opposed to the other. So for those of you who are taking micro before, you probably have seen this. If you haven't, it's a pretty good introduction to that. And so we'll talk more about that concept as we go on. Any questions before we get into the fourth objective here? And I think we'll probably get most of the way through this chapter. If we don't finish today, it's fine. We have plenty of time next week to do it. But I want to talk about this idea of the next sort of scenario here, and that's the idea of the relevant costs of revenues. That is, those costs of revenues which we account for because they are part of the decision-making process. And the scenario here is whether to sell or process further. This is an extremely common scenario, and it's at every level of an organization. And we've seen companies in the last several years decide they don't no longer want to keep doing certain things, and they farm those production processes out to others because they do it better, cheaper, and faster. And so the issue is, where do we stop in the production? One of the examples, and I know the example used in the text was that of dairy production, where you start with raw milk, which presumably is pasteurized, and then made into different joint products. We'll get to that in a second. The best example I can think of is the oil business, where you pump oil out of the ground. It's really dirty, it's messy, it's got a lot of dirt in it, and they're refining it to make different products. One of the early products is gasoline. And when gasoline was first produced, there was no use for it, so they just let it pour off into the river. And so, when I was a kid, the Cleveland River used to catch on fire because there was so much gasoline. Somebody would throw a lit cigarette and the river would catch on fire because they had nothing to do with the gasoline. There was no use for it. You keep refining it and you get kerosene. You keep refining it and you get other products, waxes, lubricants, all that kind of thing. So the question is, at what point in the production process do we stop and let someone else do it? And when we stop, that's our finished product that goes on to somebody else and becomes their raw material, right? Or do we keep on going till we get all the way from start to finish? And I think there are very few operations out there that take some raw material out of the ground, so to speak, and make some finished product. It's out there, but it's not really that common. It really is not. So the question is, at what point do we stop and say, enough production, let's sell the product, or do we keep on going to make the final output? And this is really, and it really revolves around the idea of incremental analysis. So let's talk about this. So companies have a decision rule, and the decision rule and rules in economics and finance are based upon this idea that if it's basically set up as an equation, it's the idea that we can, if incremental revenue exceeds incremental costs, then we should keep on doing what we're doing. And this is really the heart of what we call incremental cost benefit analysis. It's the idea if incremental revenue exceeds incremental costs. Once incremental costs begin to exceed incremental revenues, then we should stop doing that thing or dial it down. Remember, revenues and inflows are the same thing, right? So revenues, which is simply an accounting term, is basically equivalent to the inflows of resources, and costs or expenses, which again are two different terms representing the very same thing, are outflows. And so as a result, what we have to understand here is the idea that it's a comparison of one versus the other, inflows versus outflows. As long as inflows exceed outflows, we should keep on doing it. Ceteris paribus, that is, it does not conflict with any other objective the firm is doing. Okay. Okay, so let's take a look at some examples here of what this means with regard to a product. We're going to start with the single product case first. There's one product, and and we're gonna either make it or we're gonna buy it. And that's a big question. It's not a small question at all. Because there are a lot of companies in the world that do not make anything at all. They simply resell finished goods to buyers, marketing them up, obviously, because that's the way they make money. But the question is, maybe do we want to be involved in some aspect of the value chain going back along the chain of value to production? So in this case, the example we're given is Woodmasters makes tables. Cost of manufacture unfinished tables, $35. Unfinished would mean it's not painted, it's not finished or whatever. The selling price is $50 for the unfinished output per unit. And they have unused capacity. And again, that's one of the conditions with special pricing, special orders. I mean, I know your text sort of emphasizes the special pricing aspect of it, but the special orders aspect of it is interesting because it requires a decision. So in this case, they have unused capacity, which means they've got the ability to produce more units if they need to. And they can sell them at $60 per unit if they finish them. For a finished table, direct materials will increase $2, direct labor by $4. Variable manufacturing will go up by $2.40, which is 60% of direct labor, and no increase is anticipated in fixed manufacturing overhead. And again, what is fixed manufacturing overhead? It could be the salaries of the plant supervisor or other supervisors, quality control inspectors, depreciation, property taxes, insurance, all those kind of things. So in this regard, what have we got going on here? So let's talk about this. Let's talk about what the scenarios are. There are a few things going on here. So this is the cost for completing the unfinished product, okay? It's $35 to complete the unfinished product. And we're getting $15 for materials, labor, and overhead, so it's $35. And so the question is now, what do we do here with this particular scenario that we're given in the single product case, okay? So to lay it out here is, okay, we have the opportunity to keep producing it and sell it down the line. In other words, earning a unit selling price of 60 as opposed to 50. Does that make sense? So again, all we've done is transfer this data over the previous screen, direct materials, direct labor, manufacturing overhead. We have $35 per unit and a sales price per unit of 50 minus cost per unit of 35. We have $15 of net income per unit. This is not really contribution margin because contribution margin only accounts for variable costs. Here, this is simply gross profit, right? Per unit. So if we process it further, we raise the selling price because now people are willing to pay more for it, right? And our direct materials cost goes by $2 per unit, direct labor by $4 per unit, $2.40 manufacturing overhead, nothing changed, or variable manufacturing overhead, nothing changed with respect to fixed manufacturing overhead. So $43.40 is the unit cost, higher than 35, but it's not $10 higher, which is the amount of the price increase. So as a result, it costs us $16.60. So what's the best option here? Is to do the processing further to make more income, simply because of the fact that our revenues can outpace our costs. And that's really sort of an important consideration. What is the incremental income? Okay, we talked a bit about incremental revenue, incremental cost. And it's simply incremental simply means the change in some variable, whatever it is. And we talked about the incremental change in revenue, $10 per unit times however many units are being produced, right? I think this is more on a per unit basis. Incremental cost is going to be only $8.40. So $1.60, that's $43.40 minus 35, is incremental cost difference, which falls all the way to the bottom line and means $1.60 is the incremental net income. So as long as you're earning more income than what it costs you to produce it, you should do more of it. More. And that's a pretty common idea in business, is the idea that if it's cheaper to make something than what it is to sell it for something, keep doing what you're doing. So that's really what's going on. This is an example of what we call a single product case. We have one good going on here, and we'll get to the multi-product case in a minute. And I think it revolves around the dairy product example. But is there any questions about that? Because this is an area that I think is interesting, is the idea of saying, what does it cost us to do something different? And what is the incremental revenue doing something different? And if the incremental revenue does not exceed the incremental cost, we should stand back and say no. And again, one of the things I talked about on Monday is the idea that great investor Warren Buffett has long said one of the important attributes of business that he learned over a very long career, going back to the 1940s, is to say no sometimes. In this case, you might want to say yes, but not all these scenarios are yes answers. They could be no answers. And it's an important attribute of managing a business to know what is your business, what it is you're doing, and do you want to do something or not? So that's the single product case. So questions about that before we move on to this really more interesting idea of the joint product. I'm going to take a look at the chat box to see if anyone has anything here, and I don't see anything. So, okay, well, all right, let's move on. So the prior example was making one output, one homogeneous product, and making that decision as to what to do given the make or buy decision. In this case, though, we've got a joint product decision. And I've been talking about this a bit since Monday. It's the idea that we start with some raw material, and we have a cow here, right? And we have joint costs. And we'll talk about the nature of joint costs as being costs we really cannot consider to be irrelevant because they're going to be incurred. If we're in business at all, we're going to incur these joint costs. But here's the thing. We have two different production streams that are possible with this initial output of milk. We can take Trinity cream and keep on going, make cottage cheese, and then sell the product. Or we can stop somewhere in the middle. We can take what we call the split off point here, the skim milk, we can continue processing it to make condensed milk, or stop and sell it at some point along the line. And I have no idea what condensed milk is. I guess it's a derivative of skim milk. I'll take their word for it here. But you get the idea that what we're trying to do here is we're trying to get to, I lost my screen here. We're trying to get to the idea of what do we do given these, I think I lost, where am I here? I lost my way here, hold on. So, hold on, give me a second here. Let me find out where we are here. So I think I just deleted that slide. I think I hit the delete button, it's gone. So anyway, my bad. I deleted that entire slide. So my apologies for that. So all right, so let's talk about the multi-product case. Remember, we have two income streams. I deleted the slide, it's no longer there. But we have one that starts with milk and the other starts with skim milk. And so we're going to talk about that which goes to cream, which is the end product of this. And so we have the joint costs, which are allocated to that, of $9,000. Okay, and the cost to continue producing it is another $10,000, which takes us to $19,000 to produce cream. And if we keep on going, it's going to cost us an additional amount to produce cottage cheese. And so these are just given numbers. These are not something that we had to compute. They're just sort of given in this particular example. Okay. So that's one particular scenario. So the question is, do we simply sell the cream or keep on going? Okay. So here's the scenario. And again, we lay this out as sort of a binary condition. We either sell the product at the finishing point, at the cream point, or we can keep on going to produce cottage cheese. Okay. So if we stop, we can sell the output for $19,000 per day. There's no additional increase in cost because we're already there at this. We've already incurred it, so the revenue matches the cost, so we're there. So $19,000 per day of net income just to sell the cream. If we go further, though, we're going to increase our revenue to $27,000, but we're also going to incur more costs to do it. So as a result, the net income change is $17,000. So $19,000 versus the selling at the point of cream, as opposed to going forward, versus $17,000 means there's a $2,000 drop off if we keep on going. So let's not keep on going. Let's sell it to somebody else and we're done with it. There's no purpose in us continuing to produce the output. And I think I've mentioned before that this is really an important concept everywhere in management. It's the idea that if some other party can do something better, cheaper, and faster, let them do it. Whoever can produce the cost of this to produce cottage cheese and earn a profit in doing so should be allowed to do so. It's just not us. I say us in this particular example. Our costs do not justify it, so we're out. And I think that's an important consideration. Sometimes knowing when to not do something is as important, maybe more important than knowing when to do something. Okay, so that's the first example there. So that's the first line of production in the graphic. The second one is the idea of skim milk and what we do with that. So skim milk is a joint product cost. By the way, the joint costs are not relevant. And all we do is take joint costs for producing or for refining milk. And we allocated them to the two different output streams. One was cottage cheese, if we go that far. The other is skim milk, if we go that far. And so as a result, or condensed milk, if we go that far. So in this case, the allocated cost is $5,000. And the cost to produce it into condensed milk, which is the more refined version of this, is $8,000. So what do we have going on here? We have skim milk as a revenue issue here, and we have condensed milk. So the question is, should we keep on going or should we stop? So let's look at some of the examples here that we are getting to. So in this case, this is a separate income stream. This is what we call multiple product case. By the way, when we talk about everything regarding cows, seems to have multiple what we call joint products. I mean, the joint products go on and on and on and on. And it's not just dairy. In the case of milk, they can be condensed and they can be refined all the way to cottage cheese or all the way to condensed milk. But it's also things like leather that can be achieved as a result of it. There's one reason why the cattle business has been so profitable is because there's so many outputs that eventually could be produced as a result of that. All kinds of things. And I met a guy years ago who did something with the blood of cows in slaughterhouses and used it somewhere in the pharmaceutical industry. I have no idea what that was. I didn't really inquire, but you get the idea that we can use a lot of different parts of the input, the material input, to make all these different outputs. And so as a result, the question is, how far do we want to go with this? Do we want to do something with the blood of cows? I don't know that I would, but not necessarily, but you get the idea. So in this case, this is the condensed milk final product that is the end of the line. When we say the end of the line, it's what we consider final products. There's no more refining or production operating on it. This is the final good. In this case, what do we have here? So sales per day of the skim milk, which is one of the joint output products of the production, is 11,000. If we keep on going, we're going to 26,000, but we're only going to incur 8,000 in additional cost. And so as a result, the increase in net income is pretty substantial. So in this case, we should probably go on and we should continue to process this, particularly if our cost efficiencies are so manifest that we should do that. And so this is an element of production that really needs to be taken into account. The idea that if it costs us less to do something that it earns us, we should do more of that. In economics, we call it marginal analysis. In accounting, we call it incremental analysis. And this is a far from a unique scenario where we run into these kind of conditions all the time. Okay. All right. And quick review question here is process further as long as the incremental revenue from processing exceeds. This is pretty easy. It's incremental processing cost. That's kind of what we talked about there. So, all right, let's go on to one other example here. I'm not probably going to do a lot of work on this particular example, but it's a pretty good one because it sort of lays out the case for what we're doing here. So Easy Does It manufactures unpainted furniture for the do-it-yourself market, the DIY market. It currently sells the child's rocking chair for $25 a piece. Production costs are $12, composed of $12 variable and $8 fixed, so $20, right? Per unit, fixed and variable production costs. But they're considering painting it and selling for $35. The variable cost to paint each chair are expected to be $9, which to me seems a little bit unrealistic. $9 of paint for a child's chair, but okay, it's the example given. And fixed costs are expected to go up by $2. So the question is, do we do it or do we not? That is, do we continue to make unpainted furniture to sell to the market and let other people finish it and do what they want with it, but varnish or stain or paint or whatever, do nothing with it, right? Or do we do it ourselves? And that's the big question here, and it's an important question because it relates to a lot of what we're sort of looking at here in incremental analysis. So it's going to lay out the facts. So in this case, we're going to take a per unit basis where we can sell it for a higher price per unit. These are per unit values. $25 in the current scenario, $35 if we paint it. So we have a $10 increase to net income. So far, so good. But not so far, so good because variable costs, which are $12 currently, are going to go to $21. That's at $9 of paint per unit. I have no idea how much paint goes into a child's chair. I can't imagine, but nonetheless, it's a lot of dollar cost. So that's an increase or decrease in net income from choosing this potential scenario. Not so great. Fixed costs are going to from 8 to 10. Now remember, we're interested here in product costs, and I know we've said that fixed costs are not relevant, and they're not, except if there's a change in fixed costs, then they are relevant. Fixed costs, which are fixed, are not relevant because they're going to be what they're going to be. Insurance on the building, depreciation, all that stuff. But if they go up, then it becomes relevant. So we take the difference here, and it becomes relevant. So now we add these costs up here now, we have a $1 decrease per unit in net income. So the answer here is we should not finish these goods. Why? Because it's going to be a drag on earnings. So we should not do that. And we should just simply continue to sell the unfinished product to people, to the DIY market, and call it a day. And that's an important thing to know is sometimes we just need to stop. And by the way, this is not a small corner of the business world we're covering here. This is not some obscure fact. There are all kinds of decisions in manufacturing as to where we produce and where we stop producing. And in many cases, it's a situation where maybe we produce up to a certain point and we have to source maybe many thousands of vendors to bring in outputs, screws, wires, computer chips, circuit boards, whatever. And then we pick it back up from there because it's not profitable for us to do it given our cost profile. And in this country, we are a fairly high cost producer, frankly, high labor costs, high regulatory costs, high insurance costs. But if we can source out the output to other countries that have lower labor costs, lower regulatory costs, lower insurance costs, then it will lower the cost of doing business. So it makes sense to source these goods wherever it makes sense. Okay. And whether you like it or not is mostly not related to the question at all. And I hate to put it that way, but it is what it is. I mean, companies are going to do what is advantageous to them in terms of incremental costs in order to produce output. Okay. All right. So questions about that before we move on to the next segment, and it's the next example of incremental analysis we're going to get to. So I don't see any questions. So let's kind of move on here and talk about this idea of repairing, retaining, replacing. This is a pretty common scenario. It happens all the time where companies have fixed assets, equipment that needs to be repaired or it needs to be either replaced or repaired, and it's not always clear what the decision is. We can keep on fixing it, or we can just keep it and not fix it. That's maybe not a great option, or simply getting rid of it. And these kind of questions come up all the time, and it's particularly with regard to sophisticated products that are expensive. We're talking about vehicles, computers. One example that in my own experience, my dad was in the newspaper business, and they needed a new forklift, and they were just repairing it. There's a forklift that would move big rolls of paper around, and he really didn't want to replace the equipment. And his staff was saying, look, we're paying all this money and repairing it. Why don't you just get rid of it and buy something new? He eventually did that, but it took a while to convince him of the incremental benefit versus the incremental cost to doing that. And that's, I think, a lot of what is going on here. Management needs to be convinced. Who needs to convince management? It's the accounting staff that does it. So, and whether or not anyone here in this course plans to become an accountant, it nonetheless illustrates what the role of accountants are, and that is to lay out the facts and let decision makers make the decisions. Which is why a lot of times accountants move all the way to the very top of the organization, because they know these facts. So it's important, and I know I speak as an accountant, maybe I've got a bit of a bias in this regard, but it's nonetheless, the facts are the facts. So let's get to this example of a fixed asset. Remember, fixed assets are those assets that are fixed, not because they're fixed in place. 18-wheelers are not fixed in place, but they're fixed on the balance sheet. And the question is, at what point do we stop using those and replace those? We can repair them, and that's an option. We can repair them if they keep breaking down. But nonetheless, we may not want to keep doing it. By the way, the only variables that serve the process here are those that are subject to change. Those are the costs which are that we can affect, right? The fixed cost element may not be there, and so as a result, we're really talking about those costs which are really relevant. So in this example, we've got a company that makes a what do they make? This doesn't say what they make, but they have a machine that costs $110,000, and it's got a balance and accumulated depreciation of $70,000. And if I look at this scenario, I say right now, this is what we call a sunk cost. It's already been incurred. It's not coming back. It's done. Forget about it. Not relevant. So forget about that. It's a red herring, but you'll see this on homework quiz and whatnot. If it's already been accumulated and incurred, it's not coming back. And so we can't recover it. So it's gone. Forget about it. It's spilled milk. So the machine's book value now, 110 minus 70 is 40,000. Okay. That might be a bit relevant. The remaining useful life is 4 years. Okay. But a new machine is available, it costs 120, and it's expected to have zero salvage, which makes our life easier in this regard. And if it's 4-year useful life, and if the new machine is acquired, variable manufacturing costs, this is really the critical thing here, are expected to go from 160 to 125, maybe because it's cheaper to operate this machine. It uses less electricity, less maintenance, less whatever. And so the old unit can be sold for 5,000. If we bought this and got rid of that, right? If we keep it, we can't sell this. But if we get rid of the machine, we get 5,000 to whoever wants to buy it. And there's oftentimes a market for used production machinery. I know it doesn't sound like something that most of us are familiar with, but it is out there. There are ways here of salvage, which is why we create salvage value in the first place. In accounting, because we know there's a market out there for these particular items. So, all right, so let's do the math here. So let's lay out the facts. We either keep it or we get rid of it, right? And buy something new. So retaining, and by the way, this is a 4-year period, right? And this is important. And I want to go back here because I know when I first saw this in this edition of the text, I thought, what is going on here? But I want to make sure we were familiar with what's going on. We have a 4-year period. So manufacturing costs of the current scenario, 160 per year. That is variable costs versus 125. So this is a 4-year period. 160 times 4 is 640. 125 times 4 is 500. So you immediately got an increase in net income just from that. Okay. The new machine cost, though, which we would not incur if we kept it, is going to be 120. So that's the cost. Okay. And then the sale of the old machine is 5,000. Is if we choose this, we don't get the 5,000 from keeping from selling the equipment. Okay. So it's an opportunity cost essentially. So, and if we replace the equipment, we get that. And the 5,000 is a reduction in the cost of the new alternative. So as a result, we keep the existing equipment and we incur 640 annual. And well, I shouldn't say it was 4-year cost versus 615, so we have an increase in net income from choosing this of 25,000, okay? So again, ceteris paribus, all else remaining equal, we should replace the equipment. Now, one thing I'm going to say here, because it sort of stands out here like a sore thumb, and that's the idea that for those of you who are going to be business majors, they're going to go on to study a business bachelor's, you're going to know that some of these need revision. First of all, the savings over time are going to be incurred over time. They're going to be discounted based upon the fact that $1 here today is worth more than $1 in the future. So we have to do time value of money calculation. Also, this is a one-time cost. This is a one-time thing. This 25,000 is going to go to 145 next year. We only had to buy the equipment one time, so that's an issue there. We have to think about that. So when we flow this out on a spreadsheet, it makes a lot more sense. But the idea here is we're doing what we call undiscounting of these values, knowing that the savings is going to be incurred over 4 years. Maybe it's not quite this amount here. Okay. And by the way, so 25,000 in savings against maybe new equipment costs under 20,000. Is it a good idea? I don't really know. I mean, it depends upon what management's preferences are. And I know I was a CFO that I knew a long time ago who said, sometimes, yes, we can do something that makes a lot of sense in the very short run, but it's so small that do we want to do it? Do we want to go through all the analysis and headache and all the problems involved? I mean, we buy a new piece of equipment, maybe it doesn't work. We got to test it, we got to do all these things, we got to bring it in, we got to replace the old equipment, we have downtime. I mean, these are not insignificant questions. So I bring these up here, not that they're included in the text, but to sort of add a little bit of maybe nuance to the whole thing. So in this case, just looking at the facts, all else remaining equal, we should replace the equipment and buy new equipment. And that's not surprising that an accounting textbook would do that. I think it's an issue that has been around in business for a long time, and that's upgrading equipment. And companies just have to do it. If you don't upgrade equipment, you're really going to fall behind versus your competitors. And one of the examples I used was if you have two retailers in town, supermarkets, Albertsons and Smiths, let's say, and the first that went to the optical scanners had a huge advantage over those that did not when they were punching in prices in the old school method. Very manual, very labor driven. And I'm sure the second adopter did not want to invest in the new equipment, but they had to do it. And they had to do it because they were going to lose revenue as a result, which is essentially a reduction in net income. And so they had to kind of do it. This is the sort of driving force behind industrialization for a very long time. Okay. All right. So any questions about that scenario there? Okay, well, and what the authors like to do here is say, okay, well, we have the one scenario, but what if? What if things are different, right? In this case, okay, suppose the manager spent $90,000 repairing the machine 2 months ago. What does that mean? Well, okay, well, it's 2 months ago, and they spent repairing a machine. Well, this is not hard for us to understand. Any cost of repair you've incurred, whether it's on your car, your house, your gutters, your roof, whatever, it's done, it's gone, it's not coming back. So it's not relevant, it's an irrelevant cost. It's a sunk cost. Same like, I know not all household examples translate well to business examples, but this does. It's done, it's gone, it can't come back. So if you can't change it, then don't include it in the analysis. And we didn't know this in the early stages, but it doesn't make any difference whether we do it or not, right? It's a sunk cost, so it's done. And what is important is any kind of trade-in allowance, and that is, the trade-in allowance is basically what we would call a terminal value, residual value, salvage value, whatever you want to call it. That would be relevant because if we do one thing, we swap out this old machinery to get the new machinery, we get rid of this, the old, and we get a little bit of inflow of cash. And there's oftentimes a residual value on things like machinery and equipment and whatnot. And by the way, there's a lot of equipment out there that has been around for a very, very, very long time. And I know when I was a bank lender that we had, I sort of worked in the Rust Belt area where, lots of subcontractors doing business for, the auto industry and whatnot. And some of the equipment will be decades old. I mean, 80, 100 years old, but still good. I mean, these are robust pieces of machinery. They've been long depreciated off the books from an accounting standpoint, but they've got value. And so as a result, sometimes companies will dispose of them for whatever reason, and there's a market for somebody to demand and buy them up, which means that we've got an allowance which is relevant. Okay, so not all equipment is all used up. Computer equipment, it's a bad example because it keeps changing and it keeps upgrading. But things that are very robust in nature, even things like 18-wheelers. I've financed a lot of 18-wheelers in my time. Those things last forever. I mean, those things are decades old. You got to repair them. You got to maintain them. But those things are just robust as you would believe. So there is a market for those if somebody wants to dispose of them and gets a residual value. Okay. All right. So questions about that? Okay. Let me do another example here, and I want to talk about this example here. This is Rochester Roofing is faced with a decision, and I'm probably not going to get all the way through what I want to get to today, but that's fine. We have plenty of time next week to do it. So this is another example. A company, it's a roofing company, they have a 60-foot extension, lift for work, whatever. Okay, last year the company spent $60,000 refurbishing the lift. Okay, it sounds like a sunk cost to me right off the bat, right? It just determined that another $40,000 repair work is required if they keep that particular whatever it is, extension lift. I guess it's a crane or whatever. Alternatively, which is the plan B here, they can find a annuity lift that goes for $170 sales price, and both lifts, old and new, just kind of ironic, a little bit different, where the old and new have a 6-year useful life, remaining useful life. It's an estimate, whether it's 10 years or 4 years, it's going to be an estimate up front at the time of acquisition. But the new lift is more efficient, which was sort of the motivating factor. Those will reduce operating expenses from $70,000 to $50,000 for whatever reason. Or the company can also rent out the new lift to other contractors for $2,000 a year. So that's an increase in revenues. And the old lift is not suitable for that purpose. The old lift could currently be sold for $25,000 as a salvage if the new lift is purchased. Okay, that kind of sounds promising. The new lift, the old lift are estimated to have salvage value of 0, which kind of makes our life easier. And the estimated useful life is 6 years. Okay. Remember, estimated useful life is the expected period in which some asset that's depreciable is going to wear out to be 0 or a salvage amount, whatever. And whether these goods can last 30 more years, we don't really know. In fact, there are lots of examples of assets which have lived long beyond that, but we're only interested in the accounting proposition. Do we keep the good and fix it, or do we buy a new good? Not an uncommon scenario. Not an uncommon scenario at all. So let's lay out the facts here. So this is probably the last thing we'll get to today, and we'll just a bit to do on Monday. So the operating expenses over the 6-year period. Remember, this is 6 years, and we're talking about not discounting these for time value of money considerations. 420 versus 300,000. So we have a savings that drops to the bottom line being net income of 120. That's the first line item. If we repair it, we incur 40,000 that we don't incur if we buy a new piece of equipment. So that's another 40,000 to the bottom line. If we rent this, we get $2,000. What is it? $2,000 a year? I guess a year, right? Over 6 years is 12,000. So as a result, that's another 12,000. So it's looking pretty good here. The only thing that's different is the machine cost, which is 170, which is not incurred if you keep it, but it is if you do. So that's 170 down, and then they sell the old machine, releases 25,000 in sales price, and so that gives us 25,000. So as a result, the difference here is 433 in cost savings. These are simply cost issues. There's no revenue issue here. The only revenue issue is this particular thing, which is a opportunity cost foregone here if you don't sell it. You don't sell it. So you have 27,000 additional income. And by the way, I sort of question whether 170 should even be included here because it's a one-time cost and it's going to be depreciated over a number of years. But even with that, it makes perfect sense that we should change this out and buy a new machine, right? It makes a lot of sense to do that. And this is not even getting into the tax consequences, which are also important. And we're not going to really get to in this course, but the idea if we start over with a new machine, we can start depreciating it, writing off the depreciation as a tax deductible expense. And so all of these make a lot of sense. So in this case, the data is pretty clear. We should get rid of the old equipment and replace it with new equipment. And there are a lot of good reasons why we want to do that anyway. And it's not surprising to me. The examples that we're using in this course sort of point to the idea of replacement as being an issue. And by the way, one other thing here, I want to go back, is this thing here, and this will be the last thing, is accumulated depreciation, which is somewhere here. Where did I see it? Somewhere. Accumulated depreciation is not a relevant cost because it's already been incurred. I don't even see it. I don't know if anybody does here. Okay, well, I'm not seeing it. So, but anyway, the point is accumulated depreciation is not a relevant cost. So that would not be included as a relevant cost in this analysis. And this side by side, plan A, plan B, and what the difference is very common in incremental analysis. And this is a lot of times what managers want to see from accounting and financial staff is say, give us options, tell us what are the pros, cons, lay out the numbers and whatnot. And oftentimes, I know that we've sort of laid this out as a binary, A or B. You can't do A or B, you gotta do A. You can't do A and B, you gotta do A or B. But it can also be A, B, C, D, E, whatever. And then we choose the best alternative. And so sometimes managers like to have a lot of different options to choose from. And some of this may tie into their own objectives, which the accounting staff may not be aware of. And so I think these are all considerations that are provided by internal accounting staff to senior management so they can make decisions as to what is best for the company based upon its own particular objectives. Okay. All right, we've got about 2 minutes, and I think that's about all. I don't think I can get too far more into where we're going in the next. We have one more segment of this module to cover, and I think we can easily cover it on Monday, and also talk about some of the examples of problems and exercises from the back of the chapter. So any questions for me before we end today's discussion? Okay, well, everybody have a great weekend. Feel free to get with me if you have questions, and I'm more than happy to help. And we come back on Monday, we will start to get into some examples of all these different scenarios. We have one more bit to go over with regard to examples, but we'll do that, and then we'll cover some of the back of the chapter exercises. Have a great weekend. Happy Halloween. See you next time.